Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Moment of truth. BTC gets bumped around by hundreds of millions of dollars of leveraged liquidations as traders position themselves for the imminent spot Bitcoin ETF approval. Everything you need to know.
Next in line, Bloomberg ETF analysts predict that a spot Ethereum ETF will be approved next, while Celsius unstakes over $400 million of ETH. When will ETH finally explode to the upside?
Institutional capture incoming. VanEck commits to donating 5% of its spot Bitcoin ETF profits to Bitcoin development after doing the same for its Ethereum futures ETF. Why people are concerned.
Interest rates rising. Yields on US government debt tick up following a stronger than expected jobs report, putting pressure on small cap stocks and altcoins. How the upcoming CPI print could affect the markets.
And a closer look at last week's top performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, the crypto market experienced the kind of volatility you'd expect just before a massive crypto catalyst. As always, this volatility was caused by traders getting liquidated to the tune of hundreds of millions of dollars, with $400 million of longs being liquidated in just 2 hours. According to CoinGlass, there is almost $20 billion of futures interest open on BTC, a figure that's likely to have risen by the time you watch this video. To put things into perspective, this is an all-time high of BTC leverage, according to some estimates, and barely anyone is paying attention yet. If all goes according to plan, though, everyone will be watching BTC come Wednesday. That's because this is when BlackRock expects its spot Bitcoin ETF application to be approved, at least according to a report by Fox Business. Oddly enough, BlackRock plans to trim its workforce shortly before the approval. In any case, if you've been keeping up with all the spot Bitcoin ETF analysis, you'll know it's expected that the SEC will approve all spot ETF applications at once. This is to ensure that the regulator isn't accused of playing favourites. Note that the SEC did the same with the Ethereum futures ETFs back in October. It seems that this won't matter much, though, because BlackRock has reportedly coordinated with investors to inject $2 billion into its spot ETF on the first day. According to Bloomberg ETF analyst Eric Balkunas, this would amount to the largest first-day inflows of any ETF on record. More importantly, these inflows would likely make BlackRock's spot Bitcoin ETF the largest of the bunch by assets under management. This is by design, as ETF history suggests that the ETFs with the most initial inflows often end up being the largest, regardless of fees. Put simply, BlackRock's ETF will be the biggest. So then, how high could BTC's price go if these spot Bitcoin ETFs collectively experience billions of dollars of inflows over their first few days? Well, if you're subscribed to our weekly newsletter, you'll know the answer is not straightforward. That's because the listing will come sometime after the approval. Be sure to subscribe to our weekly newsletter using the link in the description if you haven't already, by the way. It tells you everything we foresee happening in the crypto market over the coming week. Now, given that there's likely to be a gap between the approval and the listing, it's likely that BTC will experience an initial pump on the approval news, followed by sideways price action until the actual listing. This would be rocket fuel for alts, which would likely experience twice the amount of gains. For context, the charts suggest that BTC could go as high as 50k on the news of the spot Bitcoin ETF approval. Depending on the market conditions at the time of the actual listing, there's even a small possibility that BTC could quickly hit new all-time highs, which would be unprecedented from a historical perspective. But make no mistake, if there are any issues with the approval or the listing, all of that long leverage will result in liquidations that could take BTC much lower than anyone can imagine or anticipate. So, if you insist on trading this insane volatility, then be sure to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $40,000 on the best crypto exchanges, as well as the biggest discounts on the best hardware wallets. Now, these deals are available only to our viewers for a limited time too, so check out the link in the description ASAP. Now, when it comes to how ETH could react to the spot Bitcoin ETF approval, the ETH BTC chart suggests that ETH could see some more weakness against BTC in the short term. Notably, this weakness could take ETH down to levels not seen in almost 3 years, possibly lower if there are ETF issues. However, most of you will know that ETH BTC weakness doesn't mean that ETH won't pump in fiat terms. Rather, it means that ETH is likely to pump less in fiat terms than BTC will. And depending on the delay between the approval and the actual listing, ETH could see enormous gains, even against BTC. That's just because there are also pending spot Ethereum ETF applications that the SEC has yet to decide on. For reference, the final decision dates for these Ethereum ETFs are apparently all in May. According to Bloomberg ETF analyst James Seyfarth, these Ethereum ETFs are likely to be approved. Indeed, if you watched our recent Ethereum update, you'll know that BlackRock told the SEC that the regulator must approve its spot Ethereum ETF because it approved the futures Ethereum ETFs in October. This suggests that BlackRock is putting pressure on the SEC to approve those ETFs too. As such, you can bet that all eyes will turn to ETH after the spot Bitcoin ETF is approved, as there will be an assumption by investors that it is next in line. This speculation alone could take ETH up to around $2,800, a price target that's consistent with the bull flag it appears to be painting on the weekly. There is just one caveat, however, and that's all the sell pressure ETH appears to be experiencing lately. If you follow on-chain whale trackers such as Whale Alert, you'll have noticed that tens of millions of dollars of ETH have been sent to exchanges every day for months, presumably to sell. It seems that these tens of millions could become hundreds of millions because bankrupt crypto platform Celsius is reportedly in the process of unstaking almost $500 million worth of ETH to, quote, offset certain costs incurred throughout the restructuring process. It is safe to assume that some or even all of this ETH will be sold for fiat, and the practical effect of this is that it could keep ETH's price suppressed in the short term. The silver lining is that unstaking ETH on Ethereum isn't instant. According to the block, it will take Celsius around 2 weeks to unstake its ETH. Now, the good news is that if all the spot Bitcoin ETF stuff goes according to plan, there could be more than enough buying pressure to offset the sell pressure coming from Celsius and other entities. The bad news is that this will nonetheless result in ETH underperforming against both BTC and most other large-cap alts. And note that we have an Ethereum versus Solana video coming out soon, so be sure to subscribe to the channel and ping that notification bell so you don't miss it. And while you're at it, smash that like button to give this video a boost. Now, all the hype around the Bitcoin ETFs, the Ethereum ETFs, and all the other altcoin ETFs that are likely to come in the not-so-distant future has left everyone wondering what comes next. Well, if you know your crypto history, you'll know that TradFi institutions will likely try and take control of the industry. If you watched our video about the war for Bitcoin, you'll know that TradFi institutions, once upon a time, tried to change the Bitcoin blockchain by working with exchanges, custodians, and even the largest Bitcoin miners. In the end, though, they failed because they couldn't control Bitcoin's core developers, at least not the right-thinking ones. And if you watched our video about Bitcoin and ESG, you'll know that ESG-obsessed asset managers, like BlackRock, actually aren't worried about Bitcoin's environmental footprint. They're worried about the fact that they can't govern, i.e. control, Bitcoin, and have been keeping tabs on Bitcoin's best developers. This is why the news of Van Eck using a portion of its Ethereum futures ETF profits to fund Ethereum developers is so significant, and why the news that it's planning to do the same for Bitcoin is even more significant. Newsflash: asset managers are blatantly trying to influence and control crypto development. As many on crypto Twitter have pointed out, these supposedly harmless donations to crypto developer nonprofits are very much analogous to the donations these institutions give to politicians. As the saying goes, there is no such thing as free money. It all comes with strings attached. If you watched our recent video about Bitcoin's censorship concerns, you'll know that BlackRock and other asset managers already own lots of shares in the largest Bitcoin miners. Once the Bitcoin ETFs are approved, they could oversee most of BTC's trading volume. All that's left will be Bitcoin's developers. And this threat is even more acute in Ethereum's case, because once the spot Ethereum ETFs are approved, it will set the stage for staked Ethereum ETFs. Over time, these staked Ethereum ETFs could become the largest ETH stakers out there, putting asset managers in a position to control the Ethereum blockchain. This, thankfully hypothetical scenario is a sobering case study of why you should be careful what you wish for. As macro analyst Jim Bianco has been saying all this time, risking crypto's decentralization for a few extra percentage points on assets that will rally regardless is a very dangerous trade. For what it's worth, there's arguably an incentive by the asset managers to ensure that Bitcoin, Ethereum, and other cryptocurrencies don't lose their core features, such as decentralization. That's because these are the very features that make them valuable in the eyes of most investors. The problem there is that this assumes that these asset managers are acting in the interests of their investors and will continue to do so indefinitely. The US government could put its foot down if it doesn't want the US dollar to have competition from BTC or US bond yields to compete with ETH yields. That's the real risk scenario we need to be on the lookout for. Luckily, that's a long way away for now. And speaking of bond yields, yields on long-term US government debt rose last week after the country's jobs numbers came in higher than expected. That's because they sent a signal that the US economy is resilient, specifically that it can handle short-term interest rates being at over 5% without a problem. For those unfamiliar, stocks and cryptos are heavily influenced by changes in long-term interest rates, particularly low-cap stocks and altcoins. As some of you will know, small caps and most altcoins actually saw their lows last October when long-term interest rates were hitting 5%. Since that time, long-term interest rates have been on the decline, and small-cap stocks and altcoins have been on the rise. Last week's rise in rates seems to have put a sudden stop to this rally, and if long-term rates continue to rise, then small-cap stocks and altcoins could continue to get crushed. What happens next with long-term interest rates will likely be determined by December's CPI print, which is set to be released this Thursday. You'll recall that the spot Bitcoin ETFs are expected to be approved the day before. This could support or dampen the approval rally depending on the results. Of course, if the CPI comes in higher than expected, then interest rates will likely rise in response, as investors will start to anticipate the possibility that the Fed will keep rates higher for longer. Conversely, if the CPI comes in lower than expected, then interest rates will fall and speculative assets will rally. Now, it's anyone's guess as to what the result will be, but recent CPI prints suggest that both the headline CPI and the core CPI could be bottoming, meaning they may not move much lower. Then again, the fact that petrol prices have been on the decline across the US could be enough to pull both prints down. If it does, then this decline in CPI, combined with the spot Bitcoin ETF approvals, could be rocket fuel for altcoins. If it doesn't, then it could further exaggerate the underperformance of altcoins against BTC, and possibly even set the stage for another liquidation-driven correction if there are any ETF issues. Now, this all ties into the bigger question of what kind of interest rate regime the world has entered. To bring you up to speed, some investors believe that we've entered a new period of rising interest rates, and this is due to fundamental changes to the economy that will cause more inflation, namely friendshoring. Conversely, other investors believe that inflation is likely to be short-lived due to all the innovation, notably in AI, that will cause deflation despite these economic changes. Logically, this would mean that we're still in the low interest rate regime we've been in for the last 40 years or so. Obviously, which interest rate regime we're in could have a profound impact on what bull markets in stocks and crypto look like. If we're in a higher interest rate regime environment, small caps and altcoins won't perform very well. If we're still in the low interest rate regime, they will continue to do well. And on that note, it's about time we looked at last week's top performing cryptos. So, Jessica, take it away.
Thanks, Guy. Well, last week's top performing cryptos were STEPN, Akash Network, Celestia, SEI, and Arbitrum. Starting with STEPN, its GMT token appears to have pumped due to the launch of the latest STEPN contest, which challenges the users of its innovative Move to Earn protocol to take pictures of the coolest places where they run. As you can see, GMT appears to be breaking out to the weekly chart. Although it faces some resistance around these levels, it seems it could have wiggle room to rally in the next zone of resistance, which could translate to a gain of 50% or more. Just remember that this depends on all the spot Bitcoin ETF stuff. As for Akash Network, its AKT coin appears to have pumped on the news that its decentralized computing cloud usage is nearing all-time highs. Note that we recently covered Akash Network for our Coin Bureau Club members. More details in the deals page in the description. Now, as you can see, AKT is close to hitting a critical level, a key zone of resistance, which is roughly where the local top could be for most cryptos. In AKT's case, it's already hitting new all-time highs in market cap terms, which could mean that its rally could continue indefinitely. It's a similar story for Celestia, whose TIA coin appears to have pumped due to the project's continued integration with all manners of layer 1s and layer 2s. Without getting too technical, Celestia provides critical data availability infrastructure that makes cryptos faster and cheaper to use. Lo and behold, TIA has continued to hit new all-time high after all-time high. If you have been keeping up with our top performing altcoins recently, then you'll know that TIA has appeared on this list more than a dozen times over the last few weeks. That's because it's in price discovery mode and could continue to be indefinitely. Meanwhile, SEI's SEI coin appears to have pumped for a more speculative reason, and that's that all the meme coins that are popping up on its blockchain. Note that we also did a recent review of the Solana killer for our Coin Bureau Club members. Remember, there's info on the deals page in the description. Like TIA, SEI's price action has been nothing short of explosive, but it is hard to tell whether its current pump will be sustained on the meme coins alone. It's hard to say for sure, but it is possible that last week marked a blow of top for the short to medium term. There could be some consolidation before a move higher. Finally, we have Arbitrum, whose ARB token appears to have pumped due to an increase in activity on the Ethereum layer 2. Most of you will know that Ethereum is also on the brink of a big upgrade called Dencun, which will make L2s faster and cheaper. It's possible that this contributed to ARB's pump. If this is the case, then it is possible that ARB could hit another all-time high in the coming weeks. The weekly chart suggests that this could be the case. It seems to be setting the stage for a cup and handle pattern, which could cause ARB to almost double from its current price. That would be crazy. So if you want to know which altcoins are pumping the most and also where you can trade them, then be sure to check out the Coin Bureau Telegram channel. The link will be in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
So if you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.